Welcome. This is the Insider's Edge to Real Estate Investing with James Nelson, the principal and head of Avison Young's U.S. Investment Sales Group, and his co-host, Kim Troller, from his investment sales team. In this program, you'll learn game-changing strategies to outperform the market. James will teach you how to source, execute, and capitalize on the best real estate opportunities in New York and around the world. Now, here are your hosts.
Welcome to episode number 238 of the Insider's Edge to Real Estate Investing. I am your co-host, James Nelson.
And I'm Kim Troller, also your co-host.
And today we have with us Paul Salib, who is the co-founder of Castellan Real Estate Partners and CRP Affordable Housing and Community Development. And today you're going to learn about a disciplined, cycle-aware investment approach. And Paul is going to share how early experiences in currency trading and affordable housing finance laid the foundation for building a vertically integrated multifamily platform, acquiring over 80 properties, as well as his lending portfolio, and now also his work in the affordable space.
You'll also hear about the logistics and complexities related to affordable housing. Paul discusses underwriting, risk management, and operating across cycles, along with scaling an affordable housing development business. Paul founded Castellan coming out of 2008 and 2009, right? So he has a lot of great thoughts on durability, and he also wears both hats as an investor and a lender. So he's really in tune with how to underwrite risk and withstand different market cycles.
Absolutely. And it was really great to hear how he's been able to be so successful. One of the things that I like to hear about Paul's approach to affordable housing in California is how they've been able to be competitive with even, market rate, even luxury condo developers. And it was really nice to hear that California has been so supportive of affordable housing development. So we're going to really go into the details there, as you mentioned, but also hear about his experience being a lender, and a multifamily operator. So I've known Paul for probably close to 20 years. So was really excited to have this conversation with him in person. So we're going to have a brief word from our sponsor. Before we do that, check out jamesnelson.com. We built this site for you. That is where you can find the show notes, how to connect with Paul. There's also information on a new educational course that we are rolling out in partnership with Adventures in Commercial Real Estate. Super excited about that. So again, a word from our sponsor, and we'll get right into our discussion with Paul Salib.
Avison Young's United States investment sales platform executes on multifamily office, retail, development, and specialty asset transactions across top U.S. markets. As experienced leaders in the industry, our integrated national team is here to help you make informed investment decisions, whether advising on your current holdings or identifying new opportunities nationwide. Our one unified platform is built on unparalleled collaboration and connectivity across 120 full-service offices around the world, giving clients direct access to the deepest pools of capital. We put our clients first, delivering tailor-made strategies to achieve superior results.
Welcome, everyone. We are thrilled today to have with us Paul Salib, who is co-founder of Castellan Real Estate Partners and CRP Affordable Housing and Community Development. Paul, thank you so much for joining us today.
Great to see you, and thanks for having me.
So we were talking, we've known each other at least 20, maybe 25 years, going back to my Massey & Ackle days, back when Castellan was an active buyer, then became more active on the lending space. But before we dive in to your different businesses, I think it'd be great for our audience to hear a little bit about your history and how you got into the business.
Sure. So actually, funny enough, when I, went to college, I wanted to be in sports television. I had a cousin that was a producer for NBC Sports, and he had a great job. He was the producer for Wimbledon, the French Open, the Olympics, NFL, NHL. And, that seemed a pretty cool thing to do at the time. So one summer, I actually interned at NBC Sports, and I went to Wimbledon, which was an amazing experience. I lived with like 10 other college kids, on a few blocks from the Wimbledon campus, which was just a lot of fun. And, the first day I get there, there's like 10 college kids, and they're handing out jobs. Who wants to clean the compound? Who wants to get the meals? Who wants to, do the little things that needed to be done? And then people were volunteering, and then they offered a job. Who wants to do McEnroe? Okay. And I nudged the guy next to me. I'm like, what does that mean? No. Oh, they give you a walkie-talkie and you follow John McEnroe around. I was like, that sounds good. I'll do it. Little did I know what I was getting myself into. McEnroe, he was a broadcaster for the network. And as you could probably imagine, he doesn't listen to anybody. So they, would need to know where he was because we'd be going on the air and he's nowhere to be found. So they gave me a walkie-talkie, and my only job was don't lose him. Okay. So, John didn't like having some 20-year-old college kid following him around. So he would try and lose me. And the man can walk faster than any human being I've ever seen. He would put on a hat. He'd walk through the crowds of Wimbledon. I'm trying to keep up with them. And, my press pass got me everywhere but the players' locker room by center court. Okay. So there was 2 entrances to the players' locker room. And so I would wait outside one. I made friends with a security guard who I can see, but can see the other door. So if McEnroe went out the back door, he would wave and I would run and try and catch up with him. But it was a great experience. And I actually ran into Mac maybe 6 or 7 years ago. I was playing at Sport Time in a Pro-Am tennis tournament. And I said, John, you probably don't remember me. I was your runner Wimbledon 1996. And he looked at me like he knew he had messed with me a little bit. But we had a great conversation. I told him, when I was coming out of college, I had NBC Sports on my resume. And I told stories about him and it helped get me a job. He's like, oh, look at that. Yeah. But then I realized that, I couldn't even hook my VCR at the time up to my TV. Maybe sports, production is not for me. So I was good with numbers. And back then in the late 90s, Wall Street was booming, the dot-com era. Nobody went into real estate back then. At least nobody, nobody, in my circle, it was all Wall Street, right? So I got a job out of college on the trading desk at Prudential Securities down on Wall Street, trading currencies. I wasn't trading. I was just an assistant on the desk at the time, which is a whole nother story I won't get into. But it was an interesting job. But, the one thing I didn't like about it is you're stuck in front of a computer all day long. And even in the wintertime, you get in at 5:45 a.m., you leave like 4:30, you don't see sunlight. Mm-hmm. You can't, you can't leave your desk during the day except to go grab a sandwich downstairs. Right. It's kind of depressing. So how I got into real estate, my uncle was in real estate here in the city. So he's actually a very good story. He was a building inspector. He worked for HPD in the late 60s and early 70s. He actually oversaw, he was an engineer by education. He oversaw the construction of Independence Tower down in Tribeca. He oversaw a lot of the Mitchell-Lama deals back then. And then by the late 70s, my uncle understood buildings. My father was a doctor, and with a couple other partners, they bought about 30 buildings here in the city in late 70s, 80s, and then early 90s. And back then, before the Tax Reform Act of 1986, if you were a doctor or a lawyer or some other, ordinary income type profession, you could use depreciation losses against your active income as a doctor or a lawyer. So a lot of incentive for people like my father to invest in those deals. So grew up being, hearing about real estate, but never really thought about it as a career. And, my brother, who is my partner today, he was working at Salomon Brothers at the time in their real estate group. Back then, the money would leave the bank. And then my brother's job was to paper it after paper the transaction after the money had left. So different, before the days of big regulation, and that kind of thing. And then Salomon sent him to Tokyo in the late 90s to buy non-performing loans from the Japanese banks after their real estate bubble burst, which was a great experience for him. But also we bought a lot of, defaulted mortgages in 2009, 10, and 11. So, wanted to transition to real estate, and I applied to the master's program at NYU and did that, which was a great experience. Made a lot of good, learned a lot, made a lot of good connections and friends to this day I'm still doing business with. And I actually went and taught there as an adjunct professor from, 2008 to 2021. So a long time. So NYU was great. Then I was coming out of school like end of 2003. And, 9/11 had happened. There was a recession, but the job market was getting stronger. Okay. I was contemplating a job in Greenwich, Connecticut, but didn't really want to do the reverse commute. And I caught a very lucky break in my career. I got a job at the time with a startup called Redstone Partners, which it was a startup, but a very sophisticated one because the people were very sophisticated. A couple of guys had left the related companies where they worked directly for Stephen Ross, John Sokolovic, and David Levine. They brought like 5 guys from related, teamed up with Prudential. And all we did was affordable housing. What does that mean? Primarily the Affordable Housing Tax Credit Program. And we did it as lender and we did it as developer. So we would, on the lending side, we would do higher leverage loans to affordable housing developers throughout the country. We would aggregate, we had Prudential as our balance sheet. We would aggregate a huge pool of it, then sell the A piece to Fannie or Freddie and keep the riskier piece. And then we also did, both acquisition rehabs and some ground up development. So I look back at that as a major break because I learned the affordable housing space, which we're doing a lot of today. And then, but my brother and I, saw what our uncle had done. That was always the goal, to start our own business. And there was no better time than 2008 and 2009. We had no problems. We weren't dealing with legacy issues. We could just be fully offensive at a great time. So from 2009 to 2014, we bought about 80 properties, primarily here in New York City, although we did some stuff in New Jersey, the Philly area, but primarily in New York. Mm-hmm. We built a property management company, construction, asset management, accounting, acquisitions. And, we really built a sophisticated, multifamily platform. and we executed the business plan of, getting in there, renovating, leasing, removing violations, making the buildings more energy efficient. And during that time frame, rates really came down. I'm talking 14, 15, 16, rates really dropped. And, I look back at another important, not break, but important event is we had a building in West Harlem and we paid, my uncle was old school, who I still listen to. He talked in terms of rent roll multiples. We paid 6 times for the building. We renovated it, leased it up. And then a group out of Japan paid us 18 times the rent, in like a 2-year period. So, from that point on, we'd executed the business plan. We had maximized all the value out of the property. It was a good time to exit. So from that sale forward, we were addicted to selling, packages, 4 buildings, one-off deals, you name it. So of the 80 buildings, we probably sold 65 of them. And looking back, obviously, I don't think of us as smart. I think partly lucky too, because I didn't see the hurricane coming that's come the last 6 years in our business. If you think about it, like it's been really rough, starting with the 2019 rent laws, okay, then COVID, then interest rates spiking. I mean, it's been a really bad time, right. So, and we still have a portfolio of assets here in New York today. And, we're dealing with the problems, but, we're looking back, our problems are minuscule compared to, given what's went on in the business.
Well, Paul, I love, first of all, how you found your way into the business. And I'm just picturing you running around trying to find McEnroe. And maybe, if anything, that taught you persistence, right? I mean, it's the art of chasing the deal and following through, and persistence is, I think, a big piece to success in this business, whether you're an investor or a broker. But then sometimes, being on that trading desk and sometimes early on realizing what you don't want to do is almost as valuable as figuring out what you do want to do. So really kind of circuitous, but how it all came together and to be able to partner with your brother and build out such an incredible platform. And I think I know you're being humble when you talk about kind of the right timing, and certainly that helped. But I mean, to scale and acquire over 80 assets in that short of a period is nothing short of remarkable. So so maybe tell us a little more about how Castellan then pivoted, also got active on the debt side. And then we'd also love to hear about your affordable platform that you started that's, I know, active out in California as well.
Also, before we dig into that, it would be great for our listeners to hear a breakdown, kind of fast forward to today, what your portfolio looks like in terms of market, asset type, and then equity and debt strategies.
Right. Okay. So today, really, we 3 different business lines. We still have a New York City ownership portfolio, although we're not active in that. We haven't bought anything since 2018. We're just managing the assets that we have, and over time, I'm a big believer in New York. Okay. It's gotten rocked, but I think it's come back extremely strong. the rents we're getting are huge. We have no vacancy in the retail. The capital markets are still a mess because of interest rates. But if you look at like New York City, I walk, from my office in Midtown home every night. Every restaurant is packed.
Right.
Have you seen hotel room rates lately?
Huge.
It's insane. And then office leasing. We're not in the office space, but of course I read all the publications. I mean, it's been on fire. I would not have thought this 5 years ago. When COVID hit, I didn't want to leave New York. I was like the last person to leave. And I remember driving out of Manhattan, maybe it was March 25th. I mean, it was a ghost town. I was significantly worried about the state of our business and the world. And so I'm still bullish on New York long term. I think it's got its short-term challenges, but that's a business that we still have. Okay. The second business is our bridge lending business. So after we went on that spree of buying buildings, 2014, 15, 16 came around, we were net sellers. Definitely didn't see any good acquisition opportunities. There were very few and far between. And we pivoted into the lending space because both John and I both had backgrounds in lending, him at Salomon Brothers and me at Redstone. And we knew we can, we knew we had the capital. We knew how to underwrite and lend. What we didn't know is, can we originate enough loans to make it worth our while? And looking back, a key figure in this was David Schornstein in Silver Shore. I think of our first 20 loans, probably, 16 or 17 were with him.
He's been on this show twice. He is a prolific deal maker. Yeah. That guy knows how to find opportunities. So
yeah. So we found quickly that, given our relationships in the business, and John and I make the decisions. Like, we don't have committees in the background. We don't have institutional partners, and I think that's a big advantage because we're not going to come and say, "Hey, committee said no," or our institutional partner backed out. It's always been very important to us that we control our own destiny. And we, early on in 2009, 10, we turned down some pretty significant institutional capital. Because we essentially would be working for them.
Were you working off of a credit line, or how are you making these loans?
Okay, so that's a good question. So we have a fund, that we've raised money for. We have about $600 million loan portfolio today. And, we always knew we want to be on the lower risk spectrum. Okay. Where, we don't want to put out billions of dollars. We want to have no defaults. Okay. And we made it through COVID. The interest rate hikes with really no issues whatsoever, which is pretty remarkable, looking at that. But we're very disciplined on proceeds. Okay. That's the one. If we want to do a deal and we don't get it, it's always because someone's willing to lend more. So we want to play in the lower risk spectrum. We want to make loans. And even though we're an owner operator, and we very sophisticated in property management and construction and owning, we have no interest in owning the properties we make loans on. We've made over 600 loans. We've taken 3 of them back.
Wow.
And believe me, the outcomes are fine, but they're not spectacular. Okay. So we want to get our capital. So we want to lend money, get our interest in our origination fees, get paid back, and recycle the capital. So to answer your question, we have a fund, and then we have credit facilities with the banks, and we also do one-off deals with banks. So we'll put up 30%, the bank will put up 70%. But more recently and more interestingly, we did an IPO on the Israeli Stock Exchange early last summer, which was a very interesting experience. We were approached by a banker about this time last year, Yossi Levy, great banker. He emailed, we had spoken with him years earlier, and then, he just emailed us one day. He said, "Hey, I'm in town. Want to stop by and say hello? So come on over." Had a 2-hour conversation. Really attractive capital. And, after he left, we're like, this is kind of a no-brainer. So we quantified what the busted deal cost would look like. Okay. If we're talking about initial public offering, we're assuming like, if this doesn't go well, we're going to be out a lot of money, but it was very manageable, and we decided to move forward with it. And 6 months later, we closed the IPO. We went on a roadshow to Tel Aviv, had like 30 meetings in 5 days. We had rockets shot at us, but we'll do anything for a lower cost of capital.
So casually.
No, it wasn't when we were there, like we were at a restaurant and then the sirens start going off because, Israel and the U.S. had bombed the airport in Yemen and they were retaliating, but it was no big deal. Like, it's actually a way of life there. We were in a restaurant, the sirens go off, music stops, everybody goes downstairs to down below. I wouldn't call it a bunker, but just down below. 15 minutes later, it's over, music starts again, and everybody goes about their business. But there was a rating agency. It was a real IPO. So very interesting experience, and we're looking forward to doing more, in the Israeli capital markets.
And as for your third business line, I assume that's the affordable housing platform. Can you talk a little bit about how that came about and how that's structured?
Yeah, that's a very, very good question. So given my background from my Redstone days in this space and kind of the multifamily platform we had built, over the last decade. Well, we started doing this in 2018. So yeah, about 10 years into our company, we decided to make a push into the it's called LIHTC, low income housing tax credit space. And we knew we didn't want to do New York. Politically, it's not so easy. From what I heard about it, if you weren't the top 6 players, it's hard to break in. And we decided to focus on California for several reasons. Number one, land acquisitions. Okay. When you want to buy a piece of land out there, we sometimes get a year of due diligence and 2 years to close. We're about to sign up a deal in Mountain View, right near Google's headquarters. We're going to have 3 years to close. Okay.
Wow.
Okay. So that's, and
is that because a lot of the land's not entitled and so no one's willing to take that risk with hard money? Obviously everything here in New York is hard deposit, 60 to 90 day close. So is it just because you don't necessarily know what you're getting?
It's not the market out there. The market in New York is unique in that sense. You go to other parts of the country, you can get these type of terms. Some sellers some sellers won't do that. And if the land is really a winner in the affordable space, we'll close on it, before we have our capital stack put together. So I'm not saying it's always the case, but in a lot of cases, those are the type of terms we get. And, once we win one source of funds, 1 or 2 sources of funds, the rest of the funds fall into place. So by the time we go hard, we have to have secured a key piece of funding for our capital stack, and then we're comfortable going hard.
Right. Paul, what would you say is the biggest misconception that investors have about affordable housing today?
That's a good question. You should see the properties we're building in California. Okay. First of all, California, they want their affordable housing in better neighborhoods, in better areas. They want the kids going to the better school districts. They want to be close to transportation. They want to be close to jobs. So we're building in some of the best neighborhoods in the world. Mountain View, right next to Google. Santa Clara, right next to NVIDIA. Balboa Park in San Diego, which is like the Central Park of San Diego. And you go by these buildings, you would never know they're affordable housing. Never.
Yeah, I saw the video for the project that you opened in San Diego with the courtyard. Beautiful units. Really nice looking project. But how do you compete for the land? Because here in New York, for example, we have land that clearly is priced for luxury condos. And then there's other sites where there's not a condo market where you can make a rental work. So clearly there's condo demand out in those markets that you spoke up as well. So how do you compete against the condo buyer and make the affordable math work?
Well, another plus about California is, it's a high tax state. So they have a lot of money, to throw at this problem. And they're very vigilant. They want us, the affordable crisis out there is probably worse than here in New York. And they want to solve it. So there's lots of pots of money for funds, whether, you have the tax credits, you have the tax exempt bonds, but there's all kinds of other, money for homeless veterans, money for farm workers, project-based vouchers, and the affordable rents in California are quite high because area median incomes are high. Okay. The rents and affordable housing are based off of area median income. So, if we have higher AMIs, we're able to leverage more private debt, which helps the capital stack work. We're definitely sensitive to land costs. We have the best land acquisitions guy maybe in the country, in my opinion, that works for us here in New York. He's been with us from day one, and he's really an unsung hero in what we've done out there. So, so California has a lot of money. Land acquisitions are easier. Also, a lot of good markets out there. Like here in New York, it's really just New York City. I mean, I know affordable developers do stuff up in Rochester and Syracuse in that area on Long Island. But, look at California. You have we've built in San Diego, LA, the suburbs of LA, Pasadena. We're breaking ground in Santa Clarita, and then the Bay Area. Forget it. We haven't built in San Francisco proper, but we built all around it. Burlingame, Santa Clara, Santa Cruz County, Belmont, Sonoma County. So there's just so many good markets in California, and each jurisdiction has their own pot of money to put toward affordable. Mm-hmm. So for all of those reasons, it's been great. We're breaking ground on our first deal in Nevada. We're breaking ground in Reno in a couple of weeks. We just finished something in Washington, D.C. We were actually brought in as a partner, but we ended up taking it over. We just finished that, and that's in lease up.
Affordable?
All affordable. So it's a great business. There are high barrier to entries in affordable. Number one, I did a lot of it early in my career. Two, dealing with governments is never, it's always could be challenging, and it takes a long time. And people aren't willing. You have to have a lot of patience.
So with these three business lines, which drives the most deal flow, and how do you kind of see that shifting over the next 5 to 10 years?
Well, as I said, we're not really active in the New York acquisitions anymore. So that's, I don't see much growth there. I think lending and affordable, they complement each other well. Lending is consistent, slow, and it's like the singles and doubles. And then the affordables like the triples and home runs, where they come more infrequently, but when they come, they're pretty significant. So the business is actually complement each other quite well. I think we're going to grow slowly and steadily with both. We don't have any desire to in the lending anyway, to go out and do $5 billion of loans in 1 year because, again, we want to be on the low risk, low risk deals. And it's not easy to put a lot of money out at low risk. Right. So I think both businesses will be slow and steady. Although on the affordable side, we do want to break in, we love California. We're going to continue to do a lot there. But, as I said, we're doing our first deal in Nevada. Just a little more diversification, I think, would be good.
So on the affordable business, is it really driven, I guess, by the land that you can find and what type of subsidy is available? It's almost like what comes first, because I was also, when I was looking through your portfolio, and it seems like, I don't know if it's well over a dozen projects, but, different types of uses. One was for senior housing. So are you really trying to first find the need within a municipality and then go find the land to support it? Or are you trying to find the land and then figure out what programs would be best for it?
No. Well, something I like about California, it's very fair. Meaning, if your project scores, you win, and there's not much subjectivity in the scoring system. So where we've looked at other states where it looks like it's fair, but if you dive into it, there's some subjectivity in the scoring. So to answer your question, James, we figure out, we study the regulations, and my team is excellent at this because the regulations are always changing. They study the regulations and they understand what piece of land would work. So something called highest resource, close to transit. There's an emphasis on farm workers, so the finance area of my team talks to our land acquisitions group and says, this is what we need. We need 100 to 200 units, in a rural area within a quarter mile of transportation, close to a grocery store. And then my land acquisitions team, as I said, they do an amazing job. They go out and find exactly what we're looking for. And I think we bring a New York attitude out there a little bit. Like, for example, in California, they came out with something called the supernova, like a big pot of money. And the draft regulations came out at call it 5:00 on a Wednesday. By the next morning, my team had, probably stayed up all night reading. And by the next morning, our acquisitions team had an email in their inbox. Hey guys, we need X, Y, and Z. This is what will win the supernova. And, where other developers might not have read the regulations till they were final, because they don't change much from draft to final. So we bring that attitude. Also, when we found a piece of land, that we thought was really a winner, we felt there was some competition out there, we offered to go hard $25,000 day one. Like, it's something that's so small, but the seller looks at us like we're crazy, like they've never heard of that before. So we bring our New York bag of tricks out there, and sometimes that pays dividends. Yeah.
Talk a little bit about the capital stack for these. I know it changes for, base, but you said there's different buckets of capital. So what does a typical capital stack look like? And then this is ultimately a fee-based business, right? Because are you putting your own equity into these deals?
Yeah. Let me walk you through that. So we put up all the pre-development money, which can be significant, especially if we buy the land. And it's somewhat risky capital, right? Because what happened, we're spending $1 million, $2 million more, $2, $3, $4 million on pre-development. What happens if we don't succeed in securing the rest of the funding? We could lose all of that. Knock on wood, that hasn't happened. And I think that's also a function. Again, our land acquisitions team is securing winners. And we're not going to go into a deal unless we know we can pull it off. But let me try and give the audience a back of the envelope way to look at a capital stack. So say we're building, and I'll just to use round numbers, say we're building 100 units in Mountain View. Let's just say it costs $100 million. It doesn't, but let's just say we'll get allocated $65 million of affordable housing tax credits that we'll turn around and sell to probably a bank for $60 million. Okay. That's our equity in the property. So what does the bank get? They get $65 million of tax credits that they paid $60 million for. They get 15 years of depreciation losses. And they get, most importantly, CRA credits, Community Reinvestment Act credits, which, especially the big banks, JP Morgan, Bank of America, Wells, US Bank, they really need to fulfill those needs. So that's our equity in the project. Okay. Then we'll go out and, Citibank will buy $30 million of tax exempt bonds, and that's our construction to perm loan. So we've secured 90 of the 100 million. The $10 million piece that we're missing between the equity and the debt is the tricky part. Okay. So, the state of California has different programs like the Supernova or the mixed income program. And then local municipalities also have different buckets of money, like San Diego, just as an example. There's a lot of great municipalities out there in California, but San Diego, for example, we've done several deals in, and they have different pots of soft money to fill that gap. So once we have our, in this example, 100 million to build, we get our pre-dev money back and we break ground and we build. And, what I really like about the business is, we're doing, it's a decent living, but, we're doing a lot of good for society. So, we're about to finish a project where 20% of the units are for homeless vets. We actually got the TCO yesterday on a project in Pasadena. Tenants are probably moving in as we speak. And, as you know, Pasadena was rocked by the wildfires. So, that's great. We've built for farm workers. We've built for something called at-risk of youth homelessness. So, kids that grew up in an orphanage, they're now, 18 to 24, and they're on their own for the first time. And I read something the other day which was actually quite alarming. The homelessness rate for that population is 50%.
Oh,
so we're doing a lot of good for society, and, so in addition to everyday Americans, teachers, firemen, police officers. So to me, this is a much better way to spend our time than trying to chase 15% IRRs in a traditional real estate deal.
Yeah.
Right. I'm very curious, as someone who wears both hats, you're an investor and a lender, how does that influence your underwriting standards? Do you maybe underwrite more conservatively for debt than you do for equity, or what's the kind of standard across the board?
I think that's a great question. I think our experience as an owner and a developer really helps our lending business. Okay. So, when we're looking at a loan that requires some level of construction, where it falls apart a lot of times is hard cost numbers. Okay. We build. So we know what it costs,
Right.
So for example, like especially in California, we get a loan request and we look at the borrower's hard cost numbers and they're assuming, $200 a foot. We know we just built a deal down the street for $350 a foot, So I think having our own portfolio really helps. Also with rents. Hey, what are we getting on St. Mark's Place, in 4 St. Mark's?
Right.
In rent, we just leased a unit for $90 a foot. Okay. They're telling us it's $110 a foot. So I think having that data internally helps a lot. So I think that's the biggest advantage.
Yeah, absolutely. It makes a lot of sense looking inward and just leveraging your own data. Yeah.
So maybe talk a little bit about how you run kind of a bi-coastal operation. So you're spending time here. You have an office here in New York. I think you said you have 2 or 3 offices in California. Now you're going into Reno. So do you set up a physical office there? I mean, how do you oversee this, and kind of how are the 2 separate businesses run?
Right. So we have 4 offices. We're headquartered in New York, but we have an office in San Diego, Corona, which is outside Los Angeles, and then in San Jose in the Bay Area. We have really good people out there. I'm there a lot, obviously, and our New York team is there a lot. So I'm not the only one racking up the JetBlue, status. And, we have really good people on the ground out there. We've had some growing pains, but, that we've learned from and gotten through. Reno, people don't realize this. It's only a couple hours from Sacramento, which we build a lot. So I don't see us opening an office there. And it's just a lot of oversight, and great people. Like I said, John and I, from the day we started this company, we always try and hire the best. It's the related model. Hire people smarter than you and let them do their job. So that's always been our motto. So we have great people on the ground out there, and we're always on Zooms. And like I said, we're all going out there all the time. So it works.
And how do you look to scale your business moving forward? And again, it does look like, some of the affordable developments you did were, 37, 50 units, couple over 100. You hear some of these mega developments here that are, hundreds of units. Is that part of the business model that you'd rather have multiple projects and it's easier to kind of raise capital for each? Or do you think, if you fast forward 5-10 years from now, are you doing, these massive affordable developments?
Yeah. That's a good question. In California, the 9% credits, you have the 4% credits and the 9% credits. 9% credits are for smaller deals. In terms of the bigger deals, our pipeline going forward, they are getting a little bit bigger. So right now, I think our smallest one was 25 units. Our largest is 160 with everything in the middle. Right now, we have several deals we're working on that are 150, 200, 300. Although, as it gets up there, we break them out into phases because it's hard to pull off a 300-unit affordable deal, in California. It's doable, but, that's a large tax credit chunk that, someone needs to absorb to buy. So, although the bigger deals pencil better. So it's.
And I'm sure sometimes maybe those get syndicated with multiple investors in them.
Yeah. The syndicate, the tax credit syndicators can do that, but it's more those large checks are getting hard to place.
I've got a broader capital markets question. So you founded your company coming out of the GFC. Fast forward to 2019, as you mentioned, there were the rent laws, then we had COVID, then we had the interest rate crisis. How was the distress in 2008 different than the distress that you see today? And were there any lessons that you learned during the GFC that you were able to protect yourself against when we went through this kind of new capital markets distress period following like COVID?
I think the big difference between the financial crisis and today is rates were going down back then. The Fed was really clear, we're going to do whatever it takes, cutting rates. Where, today, it looks like they want to cut rates, but yet is it going down? It doesn't seem so. So I think that's the big difference. Rates were clearly going down back then. They went nowhere but down for us. And we got very lucky. Like, I remember our first deal that we bought in 2009, the rate with New York Community Bank was 5.75, and it dropped to as low as, 2 7/8. So I think that's the big difference. Rates really declined back then, which added fuel to the fire because 12, 13, 14, as I'm sure you remember, prices exploded.
Right. And in terms of lessons, was there an area where maybe you got burned in 2008 and then like over the past few years, you were able to protect your portfolio given like the lesson that you kind of took away from that time?
Well, I think the biggest mistake we made back then is we should have bought everything.
Okay.
There were so many deals that I was arguing over a couple $100,000, with the seller that we lost. We should have bought them. But operationally, no, I don't think so.
Mm-hmm. And what about jumping back into the market? So, again, it's been several years since you bought your last property here in New York. I mean, what would it take for you to say, okay, now is the time where I feel that values have bottomed out and that we're going to have another run?
It's a good question. There's nobody I listen to more in the real estate business than my uncle. And he thinks we should be buying like crazy now.
What kind of product?
New York City apartments.
Regulated?
Regulated, not regulated,
okay,
but regulated. I mean, again, we're a family of rent roll multiples. Okay, we sold for 18. Today, you can buy for what, 5?
Yeah, in some cases.
But you have to believe that politically things are going to go back more to the center. Mm-hmm. Some of these people out there, there's a couple of groups that have bought thousands of units the last few years. I wish them well. I guess they're betting that the rent laws will become more sane, and I hope it works out for them.
Yeah. Well, it's kind of a return back to the basics of you're buying for cash flow. I mean, it used to be so many of the, those years that you talked about, a lot of those investments were predicated on selling for, a tighter exit cap. And, that was really when you made money on the deal. I mean, today, the financing is accretive and you can actually buy for cash flow, right?
Yeah. So to answer your question, would we jump back in? Maybe, but like I said, we have our hands full with our 2 businesses that are really cranking right now. And, and like I said, I think I'd rather spend my time, building affordable housing for people who really need it, than to chase, IRRs.
Mm-hmm. What about office to resi conversions?
Yeah. We've seen a lot of them on the bridge lending side. We haven't done any. I think they're harder than people think. I think if we were to back an office to resi conversion, it would have to be with a top-notch group that's done it multiple times before, because we've passed on several of them in the last couple of years. Because I think, in looking back, a big mistake I made in my career, I should have been building ground up 15 years ago. But I was always, I had a finance background. I thought renovation was the way to go. And, we did fine. But, I think building a building from the ground up is much easier than converting an office to a residential building.
It's interesting you say that because, many would say that developing is definitely the riskiest proposition because, and I certainly agree once you get out of the ground, but so much of the pre-development work and figuring out, not just entitlements, but here in New York, it's dealing with neighbors, could be dealing with the MTA. And again, it's the time. How long, it takes you, twice as long to build a project, even if it's a success. So, those, I guess, are the risks getting out of the ground. But I guess what's great about what you're doing in California is, like you said, by the time you close, it's been completely de-risked, right? Because you have everything essentially approved.
Yeah. Yeah. By the time we get to a closing table, we're fully funded at that point. And we're never going to go into a deal unless we feel 100% confident in the budget, particularly the hard cost number, because they have run on us in some examples. Like hard costs have gone nowhere but up the last 5 years, but we were able to, successfully mitigate that risk through conservative underwriting primarily.
Mm-hmm. So as we start to wrap things up, really curious about advice for, we have aspiring real estate investors, we have brokers, we have maybe investors who've done work on the fair market side that thinking about affordable. Kind of what path should someone consider getting into the business? It seems like there's so much action on the debt side right now. I think I heard the other day that there's 400 debt funds out there. So you would think on one hand, there's a lot of competition in that space, maybe a little scarier at this point to go into the equity side. Affordable seems like an entirely different business. How do you, for those looking to get into the business, kind of where would you start today?
Well, so I taught at NYU for 13 years. So I got this question all the time. Mm-hmm. I think for young people, affordable housing, is a tremendous career. Number one, it's extremely complicated. My classroom at NYU used to, used to overlook the Empire State Building. And I would tell them an affordable housing deal is more complicated than someone buying the Empire State Building. And it's true. So if you can do an affordable housing deal, you can do any deal in real estate, is my opinion. Two, with affordable housing, so few people understand it. If you understand it, you're always going to have a job, which I can't say the same for lenders or equity investors. You'll always have a job. Like I said, you're doing a ton of good for society, and it's pretty good living. Mm-hmm. So,
and how would you advise that someone gets those hard skills and learns the affordable business?
Yeah, I mean, number one, you could take some classes. I think NYU has a class now, and try and get a job, take a class, learn the business. Okay. Because when I went on my interview at Redstone Partners, whatever it was, 22 years ago, I remember being in the interview and they're talking about tax credits and tax exempt bonds and soft money and this and that. I had no idea what they were talking about. So learn the business and then try and get your foot in the door, through a lender. Citibank Community Capital, for example, is the largest lender in the country. JP Morgan, all the big banks have huge departments for this stuff. There's equity syndicators, that are always hiring. There's developers, obviously. So that's a great area for a young person to go in today. Lending's a great business too. I don't think it's as stable as a career as affordable, because one thing about affordable housing, it's such a problem in this country. I don't think it's getting solved in my lifetime. I think, and it's pretty flat, meaning like even in like the financial crisis, yes, it dipped, but deals were still getting done. Where in the lending space, you have a bad recession or a financial crisis. I mean, I remember during the financial crisis, all those Bear Stearns and Lehman bankers all out of a job. I don't think that's happening in affordable.
One last question for you, because you didn't start out in real estate. What major lessons did you learn in the securities world that you've sort of applied to the real estate business?
Well, I think I learned a lot about the world economy, trading, like being in a currency trading environment.
Yeah.
Like, CPI is coming out at 8:30 a.m. Everyone's glued to the computer. How different economics impact, financial markets. I think that was the biggest thing I learned in the currency trading.
Well, Paul, this has been amazing. Thank you so much for sharing your story. And I know our audience is going to get tremendous benefit from it. So we really appreciate it.
Yeah. Like I said, thanks for having me. It's been fun.
Thank you so much.
I want to thank you all, as always, for joining. You can go to jamesnelson.com. We built this site for you. That is where you can find the show notes for this. It's how you can connect with Paul, see all the great work that they're doing. There's also a lot of helpful tools on there. So, and last but not least, if you've not already, please subscribe to the show wherever you're listening to it. We love your feedback and ratings as well. So appreciate that. Until next week, thank you again for joining.
Thank you for listening to the Insider's Edge to Real Estate Investing. We appreciate your subscribing and sharing with your friends. If you haven't already, please connect with James at James Nelson NYC on LinkedIn, Instagram, and Twitter. Please also visit jamesnelson.com, where you can sign up for our monthly newsletter, find the show notes, other episodes, exclusive video series, and other helpful resources, so you can gain the insider's edge to real estate investing. Until next week.
This podcast is for educational purposes only and should not be relied upon for investment decisions. The opinions expressed are those of the guests and not their companies. Listeners should not act upon the information without first seeking appropriate advice from an accountant, lawyer, or other professional.